I'm not going to go through all the slides because I have you here for over an hour. I'm just going to touch bases with the most important ones. And then I'm going to stop after a couple of slides. And if you have any questions, please feel free to ask me, okay? Uh, First thing we want to do, the reason why I'm taking everybody's on the call is because they're interested in getting a mortgage, doing a first time home buyer loan. And one of the things you want to do is, hold on for a second, is look for a lender. And there's no reason why you should not do with a lender here in St. Louis or Illinois if you're going to Illinois. Um, some of these fly by night commercials and these out of town commercials that make it so easy to get a mortgage, you guys are going to charge you a higher interest rate and higher closing cost fee. The interest rates are doing very good. They're below 3% now. Okay. A couple of things I want to go over before we start the agenda that's not on the slide. I always go over it first because if I don't, I will forget to mention it. When you do get ready to go to a lender, guys, make sure you have your most current income paperwork and your most current bank statements and your last 2 years taxes. A lot of times people are shredding everything. As soon as they get it, they shred it. When you know you're going to a lender, let's say in April, you won't start keeping things in, let's say, February and March, most notably March. They're going to ask for your last 2 months pay stubs. They're going to ask for the first time your monthly bank statements. They're going to ask for your last 2 years W-2s, uh, 2019 and 2020 for this year. If you are self-employed, they need your full last 2 years taxes. Um, After April the 15th, they're going to be requiring 2021. I'm sorry, 2020 tax. There won't be any extensions you can do on the self-employed. So that's one thing I wanted to get through, you guys, because that's so important to have updated documents. Okay. So what we're going to talk about is a mortgage loan basics, qualifying for a mortgage loan, affordability and you, obtaining a mortgage loan, finding a lender, comparing loan programs. Okay. And then we're going to talk about mortgage terms, closing costs, loan fees, applying for a loan processor and underwriter, reasons for declining loans, your right as a consumer. And also keep in mind, guys, your lender is working for you. Okay. So you should feel comfortable in working with your lender. If you are shopping around, and I'm kind of skipping over some things, make sure you feel comfortable where, hey, I want to call Sharon and ask her something, or I want to email her something. You should never feel like you are bothering someone. You are a first-time home buyer. Some of the things that you, if I, like I'm talking to you today, you may not remember it next week. If you come to me in a month, who's going to remember what's being said? So always feel comfortable about asking something. There's nothing wrong with asking if you're not sure about something. The first thing is you're going to look for a fixed rate. Okay, 30 years fixed rate, no adjustable, no balloon. Fixed rate means FIX. Once you lock in that rate, it will not change unless you refinance. Okay, that's very important. But you're gonna have in your house note, and they say PITI is principal, interest, taxes, and insurance. You're gonna have your principal and interest, your real estate taxes, your homeowner's insurance, private mortgage insurance, which the initials are PMI, is insurance that protects the bank against foreclosure. This is separate from your homeowner's insurance, okay? Sometimes you can get a conventional loan versus an FHA loan. After the 2008 recession, FHA loans, the PMI is in it for 30 years. Conventional loan, after you pay 20%, it does go down and it goes away. Sometimes it's not easy to get approved for a conventional loan. condominium
I
association.
just typing.
If you, oh, somebody asked something. Someone have a question? Okay. Uh, condo fees. Condo fees are homeowners association fees. They are not in your mortgage really. That's separate. Okay. But because when you buy a condo or a townhome that has a home association, we have to add it in your monthly notes when you do the application, because that's something that we know you have to pay. So your house note maybe be $800, but we gotta add in maybe $200 for us homeowners association. We gotta make sure the loan will get approved with that in there. Okay, so that's something that's gonna be. Uh, Steps in obtaining a loan. Okay, interview local lenders. Like I said, guys, there's no reason to go with the out of town lenders. Even though I want to I almost say it's always good to see your lender face to face. Ever since COVID, I have now I did go to some closings in November and December. They were December. We have not been able to go to the close. You used to close at the title company simply because of COVID. Most of the title company, they only want people in the closing that has to sign. If you're not a sign on a loan, they usually don't want you in there, and they are doing curbside closing. So what we've been doing now, like I have somebody closing next Friday. When I get his closing documentation Thursday, I will go over those forms with him. So if he has to do a curbside closing, or if he's just in there with just a title company, he will be familiar with the paperwork that we went over already. But interviewing a local lender is easier to contact your local lender. Sometimes if you're eligible for grant money, the agencies that has the grant money may not work with out hold on, I'm trying to say, out of town lenders. Okay, and keep in mind, a lot of times the reason why they're trying to get you is their rates are higher and they will have additional closing costs or they will be higher. By compliance, which almost is like a law, we cannot charge you so much in regards to closing costs. So keep that in mind. You choose a lender, you apply for a loan. Before you start looking, guys, you want to get pre-qualified, meaning that you take all your paperwork, your taxes, your pay stubs, your bank statement. You want to find out what type of loan you're going to get, how much we're estimating your house note's going to be, how much you have to bring in out of pocket. If for some reason they run out of grant money, are you gonna be able to make up that difference? You need to know all of that before you go look, okay? If you want your seller to pay some of your closing costs, you need to let your real estate agent know, say, hey, I want my seller to help me with my closing costs. You need to find out what type of grant, if you're eligible, is out there for you to use, okay? Provide documents for loan processing. What I was basically telling you guys, your pay stubs, your taxes and bank statements, that's what they're looking for. Your underwriter will review the final approval. That's after you have a sales contract. That's when you'll file with the underwriter. That's the person who will approve or deny the file. If I have like a question that I'm not sure about, or if my customer has something in the credit report that I'm not sure about, I will go to the underwriter before I do a pre-qual letter, because we don't want any surprises coming up. And then if everything goes okay, you go to loan close. One thing. One thing that's not in the slides. A lot of times on your credit report, there may be collections or late. There may be, if you have, some people might have a bankruptcy, they ask you to write a letter of explanation explaining it. Any type of letter of explanation, guys, that you write, you want to make it short and brief and straight to the point. You don't want to have a 2-page letter. You just want to have one paragraph. And the reason why your underwriters got like 50 or more files they're reviewing every day, you don't want them looking at your file the whole time. And sometimes they may not read it because it's too long. So I always tell my people to just make it short and brief. Always write an explanation. If you're gonna put something in that letter that says, hey, I didn't get my vacation check that week. That's why I was late on so-and-so. Well, guess what? They may ask you to get a letter from your job explaining that they did not give you your check. Okay, you involve the third party. If you don't know why you was late or you can't remember, I have my customers write it in there. Just put that in the letter. They can tell from your credit history if this was something you do all the time. If not, they'd be like, okay, some things happen and you forget. Okay. Lately my mail has been late. I don't think I get mail on Saturday into Monday and Tuesday. Okay, so the whole group. You just basically what I tell people, don't write anything that you cannot back up. That's basically what I'm trying to say. Okay. Anybody got any questions?
Yes, we do have one. Hold on,
Okay.
let me find it. Hold on 1 second. Where is it? Where is it? Natasha, can you ask Sharon your question? Unmute and ask Sharon your question. Do you mind?
You want me to unmute and ask the question?
Yes, please.
Okay. Hi, everybody.
Hi, Natasha.
I missed a piece. I may have been distracted, honestly, but I was asking, what is it that the Home Buyers Association requires to be added to the loan or the mortgage? Or will you be discussing that in detail later?
Well, the homeowners association, they have a fee, an annual fee that their tenants have to pay. Well, not tenants, the condo owners have to pay. It's like it protects the outside of the condo. They have bylaws. They have regulations you have to abide by. The condo association takes care of that. That fee, I have seen it in the Globe, and this was kind of years ago, as 150 up to 400. It depends on where you move.
Okay.
And
Thank you.
a lot of times when my customers say they're looking for condo fees, especially if their debt to income is really close, I tell them, make sure you let me know how much the Home Buyers Association, because sometimes that can put them out of ratio.
Okay. Thank you.
Yeah. So that's a fee that you have to pay when you buy a condo.
Okay. Thanks.
Okay, now the 4Cs got capital, meaning assets, reserves, I'm gonna go over that. Capacity, can you afford it? We're gonna make sure that your debt to income, now I'm gonna go over that, is okay. Certain loan products you cannot, let's say you're trying to buy a $95,000 house. When you come in, I have your back end debt to income over 50%. What that means is there's not enough income or too much debt to get you up to that loan price. So what I would have to do is take it down to keep you in ratio. This is what we do when we try to get you pre-qualified. Okay. Capacity, can you afford it? That's what we're looking at. Credit history, like I was saying, depending on what's on your credit, they go back 2 years. If there's any adverse credit, I try to get a letter of explanation before I submit the loan. Okay, and then collateral is basically the house that you're purchasing. We're gonna make sure that whatever that house you're purchasing is gonna appraise out. So if you're buying an $80,000 house, it has to appraise out for 80,000 or more. And when I go back to capital assets, when I talk about that, they do look at your assets, like how much you have in your account. You have to have at least, guys, $1,000 or more in the loan, especially if you're getting grant money. That includes your earnest money, putting down on the house when you want to write a contract. Your inspections can be anywhere from $300 to $400, depending on what type of inspections you get. And then you have to pay for your appraisal. The appraisal is giving the lender money to order an appraiser to go out to make sure your house appraises out. Your earnest money and your appraisal money, you can get that credit back to you as long as we can show that it's coming from your account. And that's something that I want to talk to you about. If you're getting any type of gift funds, I always tell my customers, even though most people say, I'm not giving you money, but if you're getting any kind of gift funds for a relative or significant other, let your lender know before you deposit that money in your account. The reason why, the bank get audited. Auditors don't tell us what loans they're auditing. But certain guidelines like FHA, the federal housing, that's the government loan, they are very strict on funds that's deposited into someone's account that we cannot document. Meaning that if you deposit 2,000 and we see it's not your employment check, you have to tell us where that money came from. So if you got any type of little part-time jobs or anything where you deposit cash, hold up on that, or wait till 2 or 3 months when you have in your account. That's called a season. That's okay. But any type of money that you deposit in your account while you're in the process, you gotta have a paper trail. It will stop a closing if you don't have a paper trail. So they don't have a problem with the gift. The donor would just sign a gift letter saying, hey, I'm giving Natasha $1,500. This is from her uncle on such and such day. Can anybody guess what the issue would be that your donor might have? Just a guess. No. We got to see their bank statement. Whoever's giving you the gift money, the lender has to get proof from that donor that that's their money they're giving you. Okay, hey, you might think and I know people, I have relatives that would do this. I'm giving you the money, why I gotta show them how much I got in my account? That's true, but we have to see where it's coming from. And believe me, guys, I've been doing this 20 plus years. I've had this happen. So we want to find out if that's going to be a problem before you deposit in your account. Because if it's a problem, we need to make other arrangements, or you have to make other arrangements. I have had closings, I hadn't had it in years, but I have had closings where we couldn't document the funds and we had to delay closing. And I have had deals where the person kept they had like a little side job and they kept putting their money in their account, which I understand that. But like I was telling them, you can't keep doing that because you never know when we're gonna need a new bank statement. And he kept doing it. So when we get ready to close, they had over $2,000 that we could not document. So in order to make this work, like let's say he had $3,000 in his account. They just subtracted 2,000 from his bank statement, meaning that they only said he had $1,000. So he needed like $2,000 to close. So we were short $2,000. And what he had to do, he had to go get a gift letter. Even though he had the money, because of the rules and regulations, we couldn't use it because we could not document. And I always tell people, do not think when you get close to close and they're gonna say, hey, they want the money, they're gonna go ahead and do it. They can't do that because of compliance. If they break a compliance or don't go by compliance, lenders can get in big trouble. So just remember that, okay? Any questions about that? Okay. Qualifying for a mortgage loan continues. Down payment, you have to bring in 3% of the sales contract, 3.5%, 5%. You need to know these fees. I mean, how much you need. And if you get grant money, would that cover that? Upfront loan fees, do you have to pay anything out of pocket? Usually with us, the only thing you pay is an application deposit, which is $450, and that's when you get ready, when you have a sales contract. Closing costs and escrow, you need to get an idea about how much that's gonna cost. The closing costs will be your bank fees and the title fees. Your escrow, guys, are your taxes and insurance and your prepaid interest. You pick your own homeowner's insurance. That's up to you, but you don't have to pay it to close. Reserves. Now that has became very important since COVID. Reserves are whatever your house note is. Usually you have to have a month or 2 months reserves showing that, hey, my house note is $800. I do have $800 in a checking or savings account to show the underwriter that I have enough money at closing to pay for my house note if something were to happen. Guys, you don't have to use it. You just have to show that you have. So a good thing to do, if you get ready to close, try to close maybe 2 weeks after your payday. Or if you give me Social Security, after you get your Social Security disability, anytime after you get your income, close 2 weeks after that. That way you know for sure you have. And another thing that I have done, let me go over here, is hold on for a second. Sometimes when my customers come in, they do not have enough funds for the transaction. That's okay. As long as we got the credit, we go ahead and we try to do the pre-qualification. What I would let my borrowers know, I would say, hey, I got you approved with your sellers paying some of your closing costs, grant money, and I needed an additional $1,500 from you. So basically, I'm letting you know you need to come up with an additional $1,500 of your own money, plus the $1,000 you have to have in the deal. So there won't be any surprises. Because the thing that you do not want to have done is to get a sales contract and everything goes by dates, guys. You do not want to get a sales contract and call, and when I ask for the application deposits, something might happen where you say, oh, I don't have the 450. I feel it's going to take me another week to get it. Well, it takes 7 to 10 days to get the appraisal back. So that's 3 weeks right there. Your seller might not be so accommodating about extending closing. So that's something you might want. Qualifying for a mortgage loan, like I was talking about capacity, your current income, they're looking at your income history, future earning potential, amount owed, how much you owe on your installment account versus your revolving accounts. Installment loans, guys, are student loans, car loans, or personal loans. Those are loans that when you pay it off, it is closed. It's over with. Revolving accounts is like dealers, Sears, or Pennies. You can pay it off, but it's still open. It's revolving. And any other monthly payment, like if you have to pay child support, alimony, or if you're paying back the IRS, anything like that you need to have. Oh, one thing I want to say to you guys, we'll look at your inquiries and they'll ask you if you open up any new account. If you know you have purchased something that is not showing up on your credit report, for instance, a car. You might have just bought a car and it's not on there. Just because it's not on there when your lender run it the first time, you need to say something. The reason why I say that is they will run your credit report right before closing. So if you didn't tell me you had a car and I said, oh, you can get a loan for 90,000. Then when we get ready to close, they run your credit report and that car note shows up. What would happen, that could knock your ratios up or down. So what I tell customers is, hey, if you got something on there and we need to add in there, like your IRS, if you have to pay the IRS back, you need to go ahead and state that. We need to have everything up front so there's no surprises when you get a sales contract, because what I tell my customers is not on the slide either. They will run your credit report before you close. I've had people that has taken almost a year to find a house. I try not to run your credit report repeatedly. I only run it if it expires. And sometimes not even after that, unless you say, hey, I did something on it. Your credit report is good for 120 days. Okay. So when you're in the process of purchasing a home, do not change your credit. Do not let anybody run your credit. Do not open up any new credit accounts. If you have a Sears account and you only have $100, don't go out and buy appliance. Because if your monthly note is only 25, if you go ahead and buy appliances and it goes up to 250, it can affect your debt to income. And your debt to income is your monthly gross income plus whatever your monthly debts are and the new house note. So they take that out of consideration. So like I said, they will have to run another credit report before close. So you don't want to change. And what they're looking at is, are you paying your bills on time? How much credit are you utilizing? If you guys are still trying to get credit together to get approved for a loan, the minimum credit score requirement now is 646, your middle score, 646. One of the best ways I have found out to see your credit scores improve if you pay down your credit balance on your car or any liabilities that you have. If you got like a couple of credit accounts, hold on for a second, where's my calculator? Let's just say you got an account and your limit is $1,000. Times 35% of that. If you pay that down to 350 and keep it below, you will gradually see your credit score start going up. It took me a while to catch on. You can have a credit account and you have no lates on it. But like I said, if it's $1,000 and your balance is 850, it's gonna take slower for your credit scores to go up. That's one way to move. Are there any blemishes, collections, judgment, liens, and settlements out there? And we talk about your installment and revolve. Now, one thing that I've seen that change, if you have a collection or a medical collection, if it's less than $2,000, if I get a supplement system approval, you won't have to pay that off. And even if you do have to pay it off, we always tell you to pay it off at the closing date. Okay. What has changed since when I started? We used to tell people, okay, pay it off before close. For some reason, if you pay it off before closing now, it can affect your credit scores negatively. So we just say, hey, leave it on there. You have to pay it off at the closing time. A judgment is a lien that has to be taken care of as well. Okay. Okay. Let's cover decline loan. Reason for decline loan. Your debt to income ratio went up. Like I was saying, if we run a credit report and see that you got new debt on there, or if you late on anything, that may affect your debt to income. Employment history, if you lose your job, that unfortunately could affect you. That was happening a lot last year in the spring. They're looking at your credit history, your collateral. I had what was it? An inspection, my borrower. The inspection came back, the sellers did not want to fix anything. So of course my customer didn't want the house. So that fell through. Insufficient cash. And that's why I was saying it's so important to know how much you have to have in the deal. We get ready, get a sales contract, we don't have enough funds to close. That will stop the close. Unverified information. If something happened, like if we couldn't verify your income or your job, or we couldn't get verification from insurance, that can affect you. Credit application was incomplete if you didn't finish the application. Now, this is something that doesn't happen a lot, but it has. Like I was saying, we pick your private mortgage insurance. We would choose that. Sometimes private mortgage insurance can deny a mortgage. It's got to be something extreme or something that we didn't catch, or something that that particular insurance don't cover. If not, we would try to get with another mortgage insurance person, see if they would do it. But it's very rare once we get that far. Other credit changes while in processing. title issue. Excuse me. Excuse me one second. Okay, title issues. Usually what's on the credit report, usually the title company should have, but if there's a lien against you, sometimes that might not be on your credit report. The title company will pick up on that. And if it's something we have to prove that it's not yours or prove that it is, if it is something you cannot close without a clear title. If you cannot obtain homeowners insurance. I think I had that only once. And I can't remember why, what happened, but sometimes if you have done a lot of claim, report a lot of claim, even though you may not own a home, but let's just say rental, if you have rental insurance or car insurance, and insurance companies go by the credit scores too. So I only, like I said, had that happen once, but we was able to get some other kind of insurance. Let me see. You guys are quiet. Oh, a quiet group of people. Okay, applying for a loan. When you go to your lender, you want to discuss your loan options with them. Review all your information from your lender, agree to the terms of the loan, sign your loan applications and loan disclosures. Usually you don't have to do the loan disclosures until you have a sales contract. We don't need your original paperwork, we just need your copies, like I said, pay stubs and bank statements. And then you have to pay any front fees. Some people have a credit report fee, pay up front, some people have the appraisal, usually the appraisal will pay up front. When you do apply for a loan, guys, usually I try to take my bars both ways, FHA and conventional. If I know there's a bankruptcy, I don't even try to go conventional. If it's been the last 3 years, you usually cannot get approved. Whatever loan product you get into or go into, your loan officer should explain this is the loan product you need to do. Or they may ask you, hey, you can pick and choose whichever one you want to do. And they should show you the difference between that. No one should just say, hey, you need to do FHA and go with it. They need to explain why FHA is the best loan product. Okay. Okay. Various loan types. There's your fixed rate, which is something you guys want. Fixed. Adjustable rate means it's going to change. Home equity, I don't know why they even known that. That's after you have a mortgage. If you want to get a second loan for, it's based on your equity. So that means you have to be in there for a couple of years. Or if your appraisal comes back really high, which is really good. A balloon mortgage, I don't even know how to do that. We don't do those here. A balloon mortgage is like a demand note. It's something like, if they say your loan is due in 5 years, you have to pay it off in 5 years or refinance. I can't really think of one reason why you do a balloon instead of an arm loan. At least an arm loan. But right now it's fixed. And another thing is, it's a lot of different mortgage terms. A lot of times people use abbreviations. If you're not sure, ask, because I know sometimes the operation department here uses abbreviations on things I don't do all the time. I have to ask. The loan to value, LTV, they're going to take in consideration, like if you're doing 97%, 95% of your loan. Debt to income, like I was telling you, they're going to put in your gross monthly income, your credit, what you're paying monthly as far as your credit report, and the new mortgage payment. And another thing that I tell people, guys, for your debt to income, keep in mind that they're using your gross monthly income. Your gross monthly income always looks great, right? We would love to live on that. So on paper, it may look like, oh yeah, I can afford this $180-something thousand home. But in reality, you might say, nah, I need to stick to 125,000 because you don't want to be house poor. You want to make sure you're comfortable in whatever loan amount you decide. You are the ones that's going to make the pay. Come back and get that higher price home later. You can use the equity in your property. Prepayment, we don't have that. Most legitimate lenders do not have that. It used to be a fee to pay your mortgage off early. I know it sounds crazy, but it used to. Points, depending on the point system, when you get ready to lock in a rate, you can buy your rate down. Sometimes it could be as low as a couple of $100 and up to a couple of thousand. It just depends on how low you want to do it. Okay, your long term, 30 years, they have 30, 25, 20. Most of the time with first time home buyers, it's usually 30. But you can always pay your loan off early because there's no pre-penalty payments. Right, a rate lock-in versus a floating rate. Rate lock-in is when you have a full contract, meaning that you will lock in a rate, whatever that rate is that day. Floating rate means, hey, I want to float for a while and see what the rates are going to do. Nobody can predict that. Just keep in mind, if you do decide to float, if the rate never drops, you will have to take the rate that you have to lock in 10 days before you close. Your annual percentage rate, guys, your APR, that's on your closing documents. That is not the rate based on your loan. That's the rate based on your closing costs. That's why it's a one-time percentage rate. Okay. And then your escrow account, you always have your taxes and insurance in your monthly note. So we will set up an escrow account. So in December, we take care of paying your taxes, and whenever you close, we will take care of paying your homeowners insurance. Okay. And I think that's all I have for right now. On this last page, hold on for a second. I want to just let you see my information. This is my office number and my email address, Sharon.Johnson@centralbank.net. And my direct number is 314-835-3746. If you got any questions, or if you would like to see, if you don't have idea what your credit looks like, we can do soft pull. It basically still have to do the application, but you would get an idea of what your credit looks like and what was for you. And if you are, hello? If you do know your credit scores and you're ready to go, I'll be happy to help you at any time. But I think that's all I got, unless anybody got any questions.
So if you have any questions, go ahead and unmute and just, you can ask, or either you can put the question in the chat.
Could you repeat that phone number for you? Because I'm not on Zoom, I'm on my car phone.
I didn't hear that.
Can you repeat the phone number?
Oh, my phone number?
Yeah, your phone number. I can't tell you what the phone number is.
314-835-3746. 314-835-3746.
And I did put it in the chat to everybody. I don't know if you can see it. Are there any other questions?
Number.
I have a question.
Okay, go ahead.
Can you explain what the difference is between the interest rate and the APR again?
The interest rate is based on, that's going to be what your monthly mortgage loan is going to be on, your note. That is what you're paying. The annual percentage rate combines, well, it's a combination of all your closing costs. It's just that one-time rate, but it's not what you be paying monthly on. The annual percentage rate is always high.
Okay, thank you.
Yeah, and another thing too, your rate will also be on your note. That's the rate you lock in.
Okay, thank you.
Sure.
Hi, this is Natasha. I have a question.
Uh-huh.
Besides the obvious that the FHA loan is like a government type of loan and the conventional is not. What's the difference between the two? Or is there something that you could shoot an email to me and compare the difference?
So I can tell you right now, the government loan is 3.5% down. That used to be, FHA used to be the primary loan for first-time home buyers. That was it. Somebody said they first-time home buyer, they wanted to do that simply because you brought in less money for down payment.
Okay.
That was the
Okay.
main reason. But after, and conventional loans were always the higher, oh, that was another thing. With FHA, you can have a lower credit score. With conventional, your credit scores had to be higher and you had to bring in 5% or more. That was it. It was 5% or higher. Now, after the 2008 recession, FHA, if they both have private mortgage insurance, with conventional, you can get around that if you bring in 20% down, which most people don't. But
Okay.
after you pay 20% in the deal, PMI will go away. It will start getting lower, then it'll go away on conventional. On the FHA loan, it used to go away, but it took longer. But now, after the 2008 recession, and everybody know what that is, when the mortgage fell and people
Yeah.
was home. Okay, after that, FHA decided, hey, we're going to keep private mortgage insurance in the loan for the next 30 years until you pay it off. It's there. A lot of times, for some people do, after they have FHA for a while, they would try to refinance to get rid of it.
Mm-hmm.
But it's not something that, and then too, like we have a conventional loan where we can go down to 640 now on our scores. It's a little bit harder, but if your credit score is 680, maybe, no, let me back up. If it's 660, I have gotten it approved and you can still just bring in 3% instead of 5%. So we have changed those guidelines.
Okay.
But sometimes on a conventional loan, it's tougher to get approved sometimes on a conventional than it is for FHA. FHA is easier. On a conventional, sometimes if you have a bankruptcy, to get a scepter, it might take 5 years. On a FHA, as long as you clear after your 2 years, you can come back and do another mortgage. As long as you haven't had you didn't file bankruptcy with a property yet.
Okay. Thank you.
That answer. And so
Yes, I think.
Go ahead, I'm sorry.
Oh no, excuse me. I think I heard you say with the FHA it's like a half of a percentage less though. You kind of broke up at the beginning on my end.
FHA is 3.5%.
3.5. Okay. I heard the half. Okay. Got it.
Yeah, that's
So
why
I'm told.
it used to be the go-to loan for FHA for first-time home buyers.
Okay. Got it. All right. I have no other questions. Thank you.
Okay, sure.
Anybody else? You don't have no questions?
I have another.
Okay.
You were kind of detailing the amount of like the inspections, the appraisal, earnest money. So basically, how much money should we have in order to cover those costs?
Okay. Now it depends on you get grant money, so keep that in mind. You need to have at least $1,000 plus of your own money in the deal to pay for, like I was saying, the earnest money, appraisal, and inspection. Because that come out, that's something you pay for before closing. Now, depending on the house note, if you have a house note, let's just say it's $800 for everything, that's $1,600 plus the $1,000, that's $2,600. So I don't know if you was on the phone, but that's why I was saying, for the reserves that you need to show that you have at closing, that's why it's kind of important. To me personally, I would close 2 weeks after you get your last your paycheck. So like if you were closing, what's that? March the 2nd, and you, not March the 2nd, let's say March the 25th, and you got paid on the 12th, I would make my closing date. I would tell my realtor that I want to close on the 25th or the 26th. Because usually you will have that first couple of months of your mortgage payment when you get paid. Because you don't have to use it, you just have to show that you have it.
Right, that is there.
Right. Unless you start saving so you can put it aside. And that's one of the things when you do the pre-qualification. You will know how much money you need to save so you can say, oh, I don't have to wait, I have it already, or I will have it before close. Because now with COVID, they are very adamant that we have to show them. One of the things that we had to show back in the spring, between the spring and October, we had to show that get your last pay stub before you close. Because unfortunately, between April and June, people were losing their jobs when they had sales contract that was getting ready to close. And you cannot close if you lost your job. So knock on wood, it hasn't happened lately. Everybody doing the opposite. They seem to be going back to work.
Yeah. Okay, I have one more.
Okay.
Credit card usage.
Uh-huh.
In between your loan, house hunting, and the running of your credit report at closing.
Mm-hmm.
How much is too much to have on your credit card? If you had an amount, say for instance, you had $100 balance on your account, and then at closing it was up by 200. Does
But
that have an impact?
that shouldn't have an impact because it's still a low amount. You don't want to be like you got $100 that you got pre-qualified for, and then when we pull your credit report, it's 500 or 600, because that's going to increase your monthly payment.
Okay.
You don't want your monthly payment to double, especially if you're close to your debt to income. So like if you do 100, you charge 100, then I would just, and I always tell people, because everybody think, well, I just pay it off. No, you don't want to pay out because it can have the opposite effect. You just want to pay things down.
Okay.
So
That's
it's
good.
off that. So
Thank you.
anything that doesn't change your, just keep in mind, you don't want to change your monthly payment to double. And I got one thing that happened last month. I had somebody that was very close, but we got the debt to income ratios okay. We had to pay off a couple of things at closing, but that was fine. When we did the credit report update, he used his credit card. So I think where his monthly payment then was maybe $25 or less, it was 100. And he had to pay that off. Luckily, I think the balance was $200 or $300, but because his ratios was already close, and that's why I tell people they will run a credit report. You could get pre-qualified today, find a house Friday. Before you close in 30 days, they will do a soft pull. And if they see and on the soft pull, it does not affect your credit. But if they see something new on there, they have to do a full credit report.
Oh, wow.
Yeah. So that's why I'm saying don't change anything.
One more question. This is
And I
Natasha.
know,
Oh,
go ahead.
Have you ever gotten any of your customers or clients to get like these amazing low APRs for their houses? And did they have to have like a 800 or 850 credit score and no blemishes on their credit score
Sorry, what was
with
that?
a good history?
APR, our interest rate. Now remember, those are separate.
Thank you. Help me out. Yeah.
Okay.
I just
Yeah.
want something that's like The 1%, 2%, whatever is going, the going rate is.
Somebody told me about 1%. I ain't seen that. I'm be honest.
Okay.
But it's still 1%. The lowest rate that I did back last year was 2.125. And that
That's-
customer brought his rate down. It was everything that I've locked in for the last 2 months has been 3% or lower.
Okay.
All the way back up 3.5% or lower.
Did he have perfect credit to get that
Oh.
2%?
No, well, let's say 2.875 or 2.5. It depends on what that rate is that day when I lock them in.
Got it. Okay.
Yeah.
Okay.
And right
Thank
now,
you.
the rates are low. And it's not have to be perfect credit, but the rates are low in general. But the better your scores are, sometimes you can get that lower rate and don't have to pay anything.
Okay. Thank you.
Not a problem.
That triggered another question. So with what you were saying, what I guess the rates fluctuate daily, or
Yeah.
how does that work?
It does change, and one of the main things that changes about the rate is the pricing, really. The cost of how much to get a rate. Like I said, the guy that brought his rate down to like 2.1, his rate was like, but I won't say 4, but it was like in the 3s. But when you and he was refinancing. When you refi, you want to at least drop a point or more. And so to make it worth his while, that's why he brought 2.125. Because I think he could have got like a 2.5, but he decided, no, I'm gonna buy that down and make it even better. But everybody can't do that because it costs. I've had people that brought their rates down that cost $200. Some I had the lowest one was 40, and I've had it as high as 1,000. It just depends on pricing and what you're trying to do.
Okay.
And let me back up. I had somebody that did a purchase and was able, they brought their rate down to like, and I think it cost them that day 200 or 100 and something. And they went ahead and did it. But the next day it could have cost higher.
Okay. Okay.
And
Thank
that's why
you.
it's a gamble. You might say, oh, I'm not gonna wait to see what the rates do tomorrow. Well, the price could be worse or the rates could go up. It just depends. The main thing is you take a gamble. But what I tell my bars, okay, if we're not gonna lock in today, that's fine. Once we see that rate has gone up or whatever, I tell them that third day, we're going to jump on whatever we get. Because you don't want to take a chance of it getting higher and higher and higher. You never have an issue with it getting lower and lower and lower.
Right. Right. Because I've seen them tick up just watching it nationally.
Right. And
Just in
sometimes
the
the
last
rate,
2 weeks.
yeah, and sometimes the rate when they talk about it on TV doesn't necessarily affect us right then and there.
Mm-hmm.
They may say something about it Sunday, but it might not change anything maybe for a whole week or so. It just depends on what's going on with the market and the bonds.
Okay. Thank you.
Not a problem. Anybody else got any questions?
No, we don't have any more questions? Wow, that was almost an hour. Well, I'm excited. Well, thank you everybody for coming. If you don't have any other questions, I'm gonna stop recording. Yes, I'm gonna stop. We can actually hang up, or if you want to reach out to Sharon, you have her phone number, and you can reach out her offline if you like.